It's approximately 10 a.m. on Thursday, February the 5th, and we are witnessing an historic metal flash. As I speak to you, silver has plunged over 10% in a single session, dropping back towards the $75 level. Gold has surrendered the psychological $5,000 mark, falling nearly 9%. The 98% are looking at their screens this morning in a state of blind panic. They are seeing red candles. They are seeing their safe havens evaporate, and they are calling this the end of the run. They think the bull market in metals is over. But if you want to know why this is actually happening, you have to look past the ticker. You have to look at the three-way collision of a soaring US dollar, a hawkish Fed nominee, and a mechanical margin noose being tightened by the exchanges. Today, I'm going to show you why this great flash was mathematically inevitable, why the 38.5 trillion debt trap makes this a gift for those of you in the 2% club, and why the exit door has never been more visible than it is right now. Welcome to Money and Power. Before we break down the mechanics of this crash, if you value a voice that stays calm when the margins are being called, feel free to subscribe. We don't do hype and we don't do moonshots. We do institutional grade common sense for the 2% club. I've also noticed that many of you are already sharing these briefings via WhatsApp and SMS. That dark social growth I talk about. You are doing exactly what is necessary. You are bypassing the noise and sharing the signal. You aren't giving your friends trading tips. You're showing them how to survive a debt-to-currency spiral. Let's look at the maths that justify your conviction. The primary narrative for today's sell-off is the Warsh Shock. When President Trump nominated Kevin Warsh to lead the Federal Reserve last Friday, the market originally thought he'd be a dovish stooge who would simply lower rates to please the White House. The market was wrong. As of this week, the Senate Banking Committee is vetting Warsh, and his record is clear. He is an inflation hawk. He wants to shrink the Fed's balance sheet and defend the integrity of the dollar. The realization of this hawkish pivot has sent the US dollar index, the DXY, soaring back towards 97.7. When the dollar rises this fast, metals must fall in paper terms. It is a simple, brutal inverse relationship. The 98% see a falling silver price and think silver is losing value. The 2% club sees a rising dollar and realizes the world is desperately trying to suck liquidity back into a failing fiat system. The dollar isn't strong because the economy is healthy. It's strong because the Fed is threatening to take the punch bowl away. Now let's talk about the mechanical reason for the 10% drop today. It's not just about sentiment, it's about the CME group. Over the last 9 days, the CME has implemented 5 consecutive margin hikes. For gold, the maintenance margin was raised from 6% to 8%. For silver, it was a massive jump from 11% to 15%. When you raise the cost of holding a contract by nearly 50% in a week, you aren't just stabilizing the market, you are setting a trap for the over-leveraged. Today's plunge is a classic margin call flush. Leveraged traders who bought silver at $100 are being forced to sell their positions today to cover their collateral. They aren't selling because they want to, they are selling because they have to. This is the great deleveraging of 2026. The 98% are being shaken out by the very exchanges they trade on. Meanwhile, the bullion banks, the same ones who were caught on the wrong side of the silver squeeze last month, are using this panic to quietly cover their short positions. They are buying your silver at $75 after they sold it to you at $100. But here is the signal that no margin call can erase. While the paper price of silver drops, the structural foundations of the US economy is rotting. As of this morning, the US national debt is $38.5 trillion. In the first 3 months of fiscal year 2026, the federal government spent $270 billion on net interest payments alone. For the first time in the history of this republic, our interest payments have surpassed our total spending on national defense. Think about the absurdity of that. We're now paying more to service the ghosts of past debt than we are to defend the country in the present. Kevin Warsh might want to be a hawk. He might want to raise rates to save the dollar. But if he does, that interest payment, which is already consuming 15% of the total budget, will explode. If rates stay high, the government goes insolvent. If rates are cut, the dollar collapses. This is the impossible Trinity. The Warsh Shock is a temporary liquidity event that the 98% are obsessing over. The $38 trillion debt trap is a terminal reality that only we, the 2%, are preparing for. Adding to the perfect storm today is a sudden easing of geopolitical tension. News has broken that the US and Iran have entered bilateral nuclear talks in Oman. This was a direct request from Tehran to bypass the broader regional escalations we saw in January. The market has reacted by stripping the war premium out of gold and oil. Crude oil has slipped back towards $64. When people stop fearing an immediate missile strike, they sell their insurance to cover their losses in the equity markets. But does a meeting in Oman fix $38 trillion of debt? Does it fix the fact that the US is adding $8 billion to that debt every single day? Of course not. It is a temporary lull in the drama. The safe haven bid is evaporating today because the 98% have short memories. They think a diplomatic handshake solves a structural currency crisis. The 2% club knows better. While the West is distracted by margin calls and Warsh talk, the rest of the world is building the bypass. As of last month, the BRICS nations have launched the pilot for the unit, a digital trade currency backed 40% by physical gold and 60% by member currencies. They aren't watching the silver price on a New York exchange. They are building a world where trade is settled in hard assets, not IOUs. The BRICS bloc now controls 50% of global gold production. They are watching this Western flush with a smile because every time the paper price of gold and silver drops in London or New York, they can buy more of the physical metal with their surplus dollars. So what is the action plan for the 2% club on this chaotic Thursday? Well, first you must recognize the Warsh Shock for what it is. A liquidity squeeze, not a trend reversal. The dollar is strong today only because everything else is being liquidated. Second, watch the debt clock. The $38.5 trillion trap is the only number that matters. If interest payments continue to outpace defense, the system will eventually be forced back into money printing to stay alive. And third, use the flush. The 98% are selling because they're terrified. The 2% are holding because they understand the math. When the leverage is gone, the floor will be set. Now, this video I will not be able to edit because I want to get this out ASAP. So if there are gaps in the diction, I apologize. I'm not editing the video, it's coming as is. And I want to thank those of you who've stayed to the end of this autopsy. If you found this briefing rational while the rest of the internet is shouting about a collapse, please share it via text or WhatsApp with one person at least who is currently panicking over their portfolio. Let's help them see the signal through the noise. For the 2% club, I want to hear from you. Do you believe Kevin Warsh can actually shrink the balance sheet without collapsing the $38 trillion debt bubble? I'll be interested. Or is this just a final attempt to scare the market before the inevitable reset? Let me know in the comments. I read every single one. Stay calm, stay rational. And to see exactly how the 2% Club is positioning for the rise of the BRICS unit, watch the briefing on the global money systems on the screen now, or for a deeper look at why copper is the industrial play of the decade, click the recommendation on the other side. Thank you for watching. I'll see you in our next briefing.